It's been a little bit difficult, so it's good to see some of you that have made it in. Hi, Olivier. Thank you for joining. Just wanted to introduce the panelists. So we're joined by Hala Matar Shafani. I hope I've pronounced that right. President Middle East and Africa of HVS is, and I'm sure that you all know Hala. James Donald, who is Vice President, Deputy General Counsel Middle East for Accor Hotels, and Giuliano Gasparini, Senior Vice President, Asset Management, Hospitality and Leisure with Aldar. In terms of, I guess, housekeeping, it really depends on how many people join us, I think. The original idea was to sort of split this into two, where we had a panel discussion and we then opened up to questions and answers. So let's just see how many more people join us. If it stays the number that we're at, then I think what I'll ask Kelly, who's my assistant here helping, is that we unmute and we can, you know, all have a general conversation. But let's start with the original idea and just see how we go. In terms of questions, we actually did receive a number of questions beforehand. So to the extent that we've been able to, we've tried to sort of feed those into the topics to discuss today. And really, I think the idea is just to talk about, you know, how hotel management agreements might need to change going forwards. You know, obviously 2020 has been, you know, unprecedented. The impact on the industry has been immense, and it's impacted owners and operators alike. And many of us are in a situation where, you know, either as advisors or, you know, whatever hat we're wearing, we're in situations that we're trying to deal with. You know, some owners need to exit. Operators are, you know, have problems with some of their hotels. Everybody's under pressure, and asset managers are trying to do their best. So it's probably a good topic for us to talk about how we might need to change things going forwards. So before we get on with that, though, what I want to do is just to hand over to Hala for a couple of minutes to allow her to give us all a very brief overview of the current findings of HVS. So Hala, you have the floor.
Thank you, Tara. I guess overcoming the technical challenges, I'll bore you for a few minutes, but hopefully this will set the stage for the discussions and the key topics and commercial terms that are being negotiated. What we have done, and this publication is now available on the HVS website, so I just want to touch on the key terms rather than the entire publication and talk about the findings. We have looked at the 700 branded hotels in the Middle East. That was by end of 2019, which is the equivalent of roughly 210,000 hotel rooms. And so far, when we look at the operating model, 84% of hotels in the Middle East are under a management agreement, which is very relevant to the discussion we're having today. Only 11% are franchise and 5% are lease. Now, how does that compare to elsewhere in the world, and especially in the more mature markets? Because we observe very similar trends. When we look at the franchise model, for example, in the US, this is close to 70%, in Africa it's 25%, and in Europe, close to 40%. So what these findings then allow us to observe how management agreements, they grow and potentially opens up room also for franchise. Specifically, when we looked at the term pre-2008, and I would always specify 2008 as a turning point in the operators' negotiations. Pre-2008, we were looking at an average term in the Middle East, which is 21 years. And post-2008, this has dropped to 17 years. Now, how does that compare, for example, to the globe? The globe is at 18.6 years in terms of term. Now, one could argue that obviously the sample, when we look at the globe, has less mid-scale hotels, which typically have a shorter term, versus the upscale hotel that typically franchise less and are operated. So it's important always to look at the difference. However, what this suggests is that there has been a drop from 21 years to 17 years. This also ties into the base fees, which typically they were a flat fee ranging between 2 and 4% of total revenues or gross revenues. And this has now declined to 1.7% in the Middle East, again, when we compare it to a 2.6% in the globe. What that has been tied into is ramping up also those fees rather than a flat structure fee. So typically it ramps up in the initial years up to stabilization. In contrast, when we look at the incentive fee, however, although traditionally this was also a flat fee at around 9%, again, keeping in mind that this differs between an upscale and the mid-scale or the economy hotels, but again, we are seeing much more that these fees are now being tied to the GOP and more recently as well, the adjusted gross operating profit, the definition of gross operating profit, specifically in the Middle East, where a lot of the revenues are not necessarily generated by the rooms. It is whether there are any exclusion to outsourced facilities, whether it be it retail or the spa or some other F&B outlets. So these are, again, the key differences in looking at not just the fact that these fees are now tied to certain thresholds that are being met, but also they have declined. So we're typically looking at a 5% up to 8%, but on a number of occasions as well, and I wouldn't generalize, but we have definitely seen that these fees, they have to meet a certain minimum being 20 or 25% of adjusted gross operating profit before these fees are paid out. I know we will have further discussion around this. I just want to add specifically on incentive fees, 73% of those that we have reviewed in the management agreements have been tied to adjusted gross operating profit. Very few are tied to owner's priority. More recently, the contracts that are being negotiated, they look at the NOP of a property. They also look at minimum guarantees by the operator and potentially a capping of those fees, so what we call a cap on the total fees. The rather sticking point, and I'm sure everyone on this call would agree, and this is pretty much non-negotiable, but it's always a sticking point, is the group services fee. And that is specifically the marketing fee. So while the average is around 2 to 3% of, again, the total revenues, although with the mid-scale property, this can be calculated as a percentage of rooms revenue. It does seem that this is becoming more of a negotiation. I wouldn't call it negotiation. It is a pain point. Let me say it's a pain point to owners to really understand how they can control this cost. This is perceived as a hidden, uncontrollable cost. And whether we could bring into these management agreement clauses, at least to ensure that a certain amount of what is being paid by the owner is spent back in that specific market. So these were very visible trends that, based on what has been reviewed, what has been signed, have been observed. I would touch on 3 more and open up this discussion that whether they will continue to be relevant, why have they been a concern, and what is it that we're going to do about. One of them is being the area protection, the AOP. Every agreement, that's 92% of agreements we reviewed, they had an area protection. The bigger question, however, today is, with all the brand consolidation, how much is this area protection relevant? I mean, you may be able to restrict a brand, but with brand consolidation, there's a sister brand that is competing next door. The other point is performance test enforceability. 86% of the contracts we reviewed had a dual testing of RevPAR and as well as GOP. Again, I'll ask the legal here to comment on this, but there has been very little instances in this market in which the owner was able to apply and enforce these performance clauses, especially as they are not single test. I think now with what's happening with COVID and the condition, also the enforceability of these and how we're gonna, what is likely to be the trend in the future. And finally, just closing up on the key money contribution, which seems to become a topic of discussion. What we have observed in recent signings, that this comes predominantly in the form of a technical fee waiver rather than key money contribution. However, for existing assets that are likely to generate immediate returns to the operator, this is where they're looking to put in some money as operators. That brings it to a conclusion. I'll make also the the link to the article available in this chat. But back to you, Tara.
Thanks, Hala. Thank you. For those of you that have just joined us, thank you very much for joining, and apologies for any technical issues you might have had. We are going to start with a panel discussion now on some of the key points that Hala's already mentioned, and dig a little deeper. We've had some questions in beforehand. As I mentioned, we've had actually some really good questions and comments. Chris Hewitt from Alhambra, Zoltan Kali from Omran, and Hassan Adab from Dur have fed comments in. So hopefully we will be able to have a discussion on the points that you've raised. If anybody else has questions, can I please ask that you type them into the chat function, and then I'll be able to see them, and we can have a look through them, you know, sort of midway through, and then open up the floor a little bit. So just turning back now to our panel discussion with Hala, Giuliano, and James. I mean, really, we want to pick up on some of the, you know, the points that have already been fed into us, some of the points that Hala's raised, and a general discussion about how management agreements, some of the key provisions in them might need to change going forwards. You know, we're in a situation now where we are backwards looking. You know, everybody's digging agreements out of drawers where they've got issues, and you know, we're looking at a regime that has been in place for a long time. But you know, do we need to address how that now changes going forwards? Are we going to be seeing things done differently? You know, one of the issues at the moment for owners particularly is the pressure that they are under in respect of performance of their assets. You know, whether this pressure is being driven by their lenders, you know, with their finance leveraging. You know, do they have ideas where they actually would benefit financially to move out of having the property traded as a hotel, and you know, do they want to look at long-term residences that they may manage themselves? You know, there are so many different options that are being floated around at the moment, and I think one thing that everybody's seen is obviously, you know, management agreements aren't particularly flexible to accommodate other scenarios, and so that's something that we'll look at today. But before we look at flexibility, I think one of the key issues, and it's a theme that's run through all of the comments that have come in, and comments that Hala has just made, is really looking at fees and charges, and you know, how maybe these can be approached differently, and whether they should be approached differently. You know, we have Giuliano, who wears an owner's hat in his role as asset manager, and we're joined by James as well, who's obviously on the operator side. So we've got a nice blend. So perhaps, James, I can bring you in and ask you to open this conversation. Well, one of the comments we had in was, you know, is it the case that the operator's strategy right now is to really stabilize their fees, you know, look at protecting their values of their companies for their shareholders, minimizing risk to the market? Is that the case? Or do you think that operators, given that they've got a lot of skin in the game and they're also feeling the pain, do you think that they would have an appetite to entertain a general approach, changing approach to the way we're looking at fees and charges generally?
Yeah, I think it's a really good question, Tara, and it's obviously a hot topic at the moment. I mean, as far as we're concerned, from a course perspective, I think it's obviously extremely important for us to stabilize the estate, to look at fees coming in, make sure that we can protect those going forward. That doesn't mean we're not alive to our partners' concerns. I mean, at the peak of this crisis, like all the big operators, we must have been looking at well over 60, 70% of our hotels closed. And, you know, that, in a way, that was a mutual decision. In many cases, yes, it was mandated by the government, but in other cases, we fully appreciate that you can't look at a hotel that drops from having 80, 90% occupancy to zero for months on end and expect us to, you know, continue collecting fees. So I think there is a perception that operators can be quite rigid, but I think I really believe that in the last 6 months, we have shown quite a degree of flexibility for existing owners who have had huge problems, and, you know, in an unprecedented, once in a generation, once in a lifetime event that this has been. And what we've really found is where owners have come to us and been really very transparent, because it's really helped. It's really helped the conversation. I don't think I'd be alone in thinking this, but there's been a desire in this region to move to more of a North American model where operators have got more skin in the game, or European model where operators have got more skin in the game. And operators are, as you said, Hala, as well, you know, the base fees have been reduced here and depressed here compared to other parts of the world. And so we're in a place where we want to help owners, but we are also mindful of the fees that we get out of it as well. And so where owners have come to us and said, look, we've had huge problems, we're going to have huge problems paying our employees, for example, we've looked at ways to address this and looked at cost reduction measures, and also looked at deferral of fees where it may be appropriate for periods of time. So I think more than any other period, that certainly in my 10 years of working in hospitality, we've seen more of an approach of collaboration in terms of being accommodating, certainly on a cause level, and I know in some of the other operators as well, of approaching this challenge together. And I think that will continue going forward. I don't know whether you think the same way, Giuliano. I know you're on the owner's side, but...
Well, I guess, I mean, we control hotels with different operators, so we really appreciated the difference in the approach of the different operators. What I've noticed is that there was absolutely no question in cutting out certain lines of the P&Ls that were not relevant for the operators, talking about FF&E reserve, for example, that has been put down to zero, or stopping any PIP project. But for what concerns operators' fee, and that's where they really put the skin on the game, I've mostly seen a deferral on the payment as a maximum, let's say, help for the owners. But ultimately, that doesn't really help in the sense that it's a deferral of a cost that is happening in any case. We only had a very local operators who actually decided not to charge any fees for 6 months. And again, but all the major international operators, they wanted to have their fees untouched. Yes, there was lots of cost savings, there were lots of reducing in payroll, brand standards have been very flexible. So we were also surprised by all of that, because in accordance with the contract, they could have not done it. But for what concerns what would have really hit them and their cash flow, that was maximum deferral, which I also understand that they need to protect the value of their shares. But ultimately, and again, going also back to what Tara and Hala were saying earlier, marketing fees have not been reduced, but as a matter of fact, the people that were involved in the regional sales office have been sent home, have been made redundant, or have been receiving furloughs. So for that perspective, we are paying now the same amount of marketing fee in accordance with the market, but I'm not sure we will receive the same service and the same support. So for that perspective, I guess we need to see in the medium term and long term how that will evolve, and if that makes sense to still keep on paying certain level of marketing fees.
Interesting. I mean, you know, some of the comments have been around, you know, the transparency of the charges and what owners are getting back for them, I think particularly on the loyalty programs. Before we move to that, I mean, maybe let's just sort of stay with the fee structures at the moment, because, you know, we're in a good position in the Middle East that actually, you know, we're all dealing with new hotel projects that are coming through. So it's, you know, there are many positives that we can all take from this. And it does give us a chance to look at things differently. So I mean, perhaps Hala, I can turn to you. You know, you had some ideas as to how we might approach incentive fee calculations going forwards. Perhaps you'd like to talk about that a
Yes,
little bit
Tara.
further.
Thank you. And if I could just add, because at one point we were discussing about the operators' flexibility since the beginning of this year. Again, this is a very unusual year, and the majority of operators realize that and have been extremely flexible. But to James' point, what I shared earlier on demonstrates that operators have been flexible. I mean, from the operator standpoint, they wanted to grow and they realized the market has become much more competitive. And as a result, this is why there has been a real transformation in those key terms. When I spoke about, for example, 11% of the contracts being only franchise, the very recent signing, which is in the last 3 years, suggests that by the end of 2020, the number of contracts would increase that are under a franchise model would increase to 20% in the Middle East. And I think this is really telling to the extent that there is as much that the operator can do and as much flexibility they can demonstrate. And equally, in the current challenging conditions, and that's not just 2020, but in the last couple of years, the NOIs have been declining as a result, whether from a RevPAR standpoint, but also more importantly is these costs, whether direct, indirect. The truth of the matter as an owner, as you said, Tara, earlier on, it's a serious challenge for them. They have to cut costs in order to meet their financial obligation. I personally see that there will be further evolution in the management contracts, certainly, but also much more turning into a franchise model where the owner has the ability to control these costs, specifically as it relates to these costs that is difficult to really justify. Now, on the incentive fee in particular, although this has started, but more recently, it's a function of saying the incentive fee is to incentivize. So whereas the base fee is calculated on the top line, we need to understand what is happening at the bottom line of the property. So the more, my personal view is, the higher the GOP, AGOP level, the higher will be the incentive fee. So we may very much likely see a much higher incentive fee, but when certain thresholds are met, and potentially linking that to cash flow or the NOP, which, as you know, again, as we look at it today, there are only very few. I'm not sure if Giuliano has an experience or have managed to sign any agreement. He can tell us more, but there are only very few that currently are tied to the NOP. And at that point in time, the question is back to the operator, can they afford that unless they are looking to put some skin in the game?
Well, I mean, Anna, if I can pick up from that, we said that earlier that the definition of adjusted GOP has changed a lot. Before it was just GOP minus base fee. Now we have, for example, GOP minus base fee minus accommodation and transportation. With the change in USALI, there was a massive change in the P&L as well, and lots of costs moved below GOP. So de facto, we were incrementing to GOP at parity of performance. So we renegotiated with the operator to have incentive fee calculating on adjusted GOP minus staff accommodation and transportation. That leaves as a fixed expense only property insurance. So de facto, it's like having an NOP before FF&E. And I guess that would be the next step. Ultimately, to have the interest of the operator and the owners align, only the bottom line is the clear line where everybody can measure himself against. So I guess the future, if I were to renegotiate a contract, I would put incentive fee based on NOP, even NOP after FF&E, for example. But going back also to your point about franchise, I fully agree. I mean, we just franchised 6 properties, and the kind of grasp that you have, the kind of decision that you're taking brings you a little bit more, let's say, on the ground. But at the same time, you're also able to shape the future and the destiny of the property in a different direction sometimes, not specifically in line with what the operators would have done. So if I were to renegotiate a management contract today, I would definitely include an option to switch into franchise. Not necessarily a manchise, but not with a franchise option, maybe as an addendum of the contract that could be triggered at any time from the owners, for example.
Yeah, and perhaps I can bring James into this discussion, you know, wearing an operator hat and without asking, you know, Accor's position, but just going back to the discussion on the incentive fees and linking it to NOP, is that something that you think operators would have an appetite to consider? What would your concerns be from the other side of the fence?
Yeah, I mean, it's hard. It is difficult in certain cases to link it to NOP. We have done it, and I know other operators have done it as well. I think where that happens, you want to cap some of the amounts that are falling into that equation. So you don't want it open-ended, because ultimately it's a different calculation. And historically, where we've gone off GOP and AGOP and moving towards an NOP model, is you have to look a lot more closely on how you're capitalizing some of these. So I think you will see more of it. I think more questions will come in. Ultimately, I'm always going to say, as an operator, I think the current AGOP apportionment is a fair allocation of how you split the risk and how you split the reward in the business. But ultimately, you're right that there are increasing questions coming on that.
Yeah, and just I guess touching on franchising, and we're not going to spend a lot of time on franchising in this session, because there is another session that deals with that. But it's interesting. We've had a comment whilst we've been speaking from Chris Hewitt in respect of group services and marketing fees, saying that in many cases, these haven't been reduced despite, little to no sales efforts from regional offices. And this obviously shows the case of OTA channels driving the majority of demand. I guess that's something that, from an owner's point of view, they will factor in a franchise consideration. Obviously, operators are willing to consider franchises with owners that they are comfortable with and that have the experience and the sophistication. But from an owner's point of view, these additional charges, if they're not seeing much value for the amount that they're paying, this is something that they would either want to see maybe reduced, removed, or to take more control through a franchise option for them. They're all tied up really together, aren't they, these issues?
I mean, I'm sorry to interject, but you have marketing fees under franchise and management contract in any case. I guess the concern from my perspective, and again with my owner's hat, is that I look at the sales team of the operators, and they have been chopped down in the last 2 or 3 months. So there's only 50% of the people left. And I understand that the volume and the cash generated by these marketing fees is much lower. But at the same time, the workload that they're doing is very minimal, because there's no travel, especially in the UAE. So what is the benefit from an owner from these teams at the moment? I can't wait for the border between Dubai and Abu Dhabi to be lightened up, and I'm going to go and visit the operators and going to count how many sales team do they still have, because we haven't been receiving any reduction on that cost. So
yeah.
And Tara, if I could just add to this one, again, pre-2020, the bigger challenge in the Middle East with this fee is when you're looking at how much the OTAs are generating, but also on your actual sales cost or marketing team at the property. So it's no longer just a function of the 2 to 3%. It is at times up to 11 and 12% of total revenues when you're adding up all these costs. Arguably, if I want to look at it commercially and also negotiated, I totally get where the operators are coming from. They're trying for all their owners to receive the same treatment, and therefore every owner will have to contribute equally. But it is also very market specific in terms of the loyalty, how many come through that direct channel. And again, all operators are very committed with their platforms and bookings, but the market conditions have different realities. And going forward, I think this is where, when you look at the franchise model, yes, you're still paying, but at times it's very much paying to what is generated by the brand rather than paying for every other channel for marketing the property.
Yeah. James, do you want to add anything to that?
No, I mean, to be honest, I think that's right, Hala. I don't think that there's anything other than, anything more to add on that.
Okay, okay. The other point that was raised was looking at, you know, greater use of owner's priority return. In place almost of a performance test, because we all know that there are issues with performance tests, and obviously you know, with the situation that we have at the moment and the impact of force majeure, that's going to muddy the waters even further. So Hala, this was something that you, and I think also Giuliano, wanted to speak about, looking at using the owner's priority return as a different way of approaching this.
Hala, if you want, I can start on that. I mean, we recently used and included an owner's priority in our management contract negotiation. And that, of course, had two major effects. One is because if you have an owner's priority, you don't really have to worry that much about the performance clause, because you always have a nice fallback option. And the second is that was a rebranding and a refurbishment. So we also wanted to make sure that there was a sort of a ROI from the investment in the rebranding and the capex that got attached to it. So there was two angles that we looked at it, and the priority was sorting out both of these issues. I think there will be more priority returns coming up, because then that means that the owners can be a little bit more hands off in asset management and leave the operators do their job, which is what it used to be before 2008. But then more recently, owners have realized that hotels are not performing as well. Before, they were distracted by the success of the other asset classes, and now they're scrutinizing the hotel. So a priority return could be a nice gentleman way to give, again, freedom to the operators, but to give a certain sort of offense.
Yeah, I think you're right. I mean, from the owner's point of view, it allows a focus on their property, which I think is always something that they would like to see more of. Whereas the operators have typically always liked to have that market benchmark, so that, you know, they can see how they're doing against others. So there's a bit of a conflict there. I mean, Hala, how do you see this issue playing
Again,
out?
I was just going to add to the fact that, you know, the reason we're discussing how these terms will likely change is because of the value of these assets. And I have to look at it simply as, you know, from the standpoint of what is the owner taking home, the value of the asset, and if it's being optimized. Now, one of the discussions, but also a lot of reliance in the past, is to define a competitive set, and that ties into the performance clause and the enforceability. It suggests that, you know, if the operator is over-penetrating the competitive set and they have a high index in RevPAR, then they're doing well, which is true, but to the extent that this may not necessarily always translate to the bottom line. The bigger challenge, at least in this part of the world, has not necessarily been in the international well-established operator in achieving RevPAR. And in fact, this is why owners have a preference to those operators, because they know they have the ability to generate the rooms revenue and the rate. But it has been more a function of tying it back into how are they managing the expenses. And what we have seen in our valuation index in 2019 is that hotel values in the Middle East have declined between 2009 and 2019 by 30%. This 30% is pretty much between, you know, across the expenses. I am not again suggesting that every operator or that operators are not necessarily managing efficiently, but this is where giving a higher incentive should incentivize the operator to manage the property. At times, there are just very aggressive development plans that perhaps some of these properties are not managed in a way where it's optimizing the value. Owner's priority will become an ask. The question is whether operators will be willing to entertain that and at what cost. So it all seems to be going back to, typically this is what gives more room and opportunities for established operators to be able to negotiate different type of operating agreements with the operator, and mostly going into a franchise model. If operators, again, this is not to generalize, there will be operators that are willing to entertain and they have the ability to manage and guarantee the bottom line. But in a competitive market, especially with the next 5 years being quite challenging, on one hand, the oversupply situation, but also the recovery from what we have been through, it may be a win-win actually for both, with operators carrying lower risk and owners carrying lower risk.
And I think it depends on the market as well, right? It depends on the product in the market, where it is. I mean, Accor and the other operators do consider priority returns for the right asset. I know it's very in fashion and has been in fashion for a long time to say the performance test doesn't really have any teeth. I disagree to an extent, and we have been the RGI. When you look at the RGI index, you do want to be obviously comparing to your competitive set. You get to choose the competitive set in terms of with the owner and figure out exactly who you should be competing against. And you're right, in terms of having the GOP, there is the GOP element as well. Of course, it's better to have your owner priority return and protect the investment that you want to make or the return that you want to make. And it is something, you're absolutely right, we're seeing more of. I just don't think it's absolutely necessary in every scenario, and it will depend a lot on market positioning and brand as well.
Yeah, no, 100% agreed. The only challenge that we've seen so far with these performance tests is that they are oftentimes, if not all times, dual, and the operator will actually have to fail both. So while you may be achieving your RevPAR test, but failing the GOP, now it is clear that some operators are able to manage on both levels, top line and bottom line, whereas others, they are very good at maintaining their RevPAR rather than managing efficiently. But I totally agree with you, James. It is very much asset market specific in terms of guaranteeing owners' priority.
I mean,
It is, and I think...
there's also the part of competitive set. Not really recently, but before a couple of years ago, there was a massive amount of supply coming in. So for certain type of property, and I have an example of Desert Resort, for example, we probably should have changed the competitive set every 2 years, because every 2 years there were new resort coming in or new resort being rebranded. So at the same time, also the bookshelf life of a competitive set, especially in this region, is much, much shorter than Europe, for example, where it's more difficult to set up new hotels in city centers.
I think that's a fair comment as well. And you see when the supply is changing a lot, I think that there's an onus on, certainly we build into our management contracts that you can discuss the competitive set annually if you feel like things should change.
Yeah, and I think as well, smaller operators that are trying to get a foothold for their brands in the market have typically shown more flexibility on these types of issues. And then, you've had a lot of consolidation, as we all know, over the last couple of years with the bigger brand stables. And, there are swings and roundabouts on both sides, because the reach of the bigger brands is obviously of benefit, but then you lose the flexibility that you get from the smaller operators. So it can be a bit of a trade-off. I'm conscious of time, so perhaps keeping on the theme of flexibility, if we could touch on some of the other topics and then maybe open up to questions and to a bit more of an open discussion, because in terms of flexibility, it's not just fees, which, of course, they're a big part of it, but as Hala said at the beginning, over the years, obviously the term of a management agreement has reduced. We've got more examples of franchise or an option to, go straight into a franchise at some point. What we don't see that much of here are exit clauses, where an owner may want at some point to take a break and step out of the relationship in order to do something else with its assets. So generally, how do we look at maybe building in flexibility to the relationship in other areas, whether it's the term of the the agreement, and given how important that is to operators and how they value their businesses, you know, a break clause with an element of compensation. I'd like to open up for that discussion between you. Hala, do you want to let us have your thoughts?
Again, it's one of those tricky ones, because my personal opinion is that this will come at a certain cost. I mean, operators would be willing to go for a shorter term. We have seen contracts that are only 10-year. Again, these are not the norm, but these are 10-year contracts, giving the owner opportunity to exit, but at a higher fees. It is going to be a function as to what is important and what is the longer term vision of the client. I've seen clients requesting and insisting on having exit clauses because they're either looking to sell or they're looking to enter into a franchise or build their own management company. So also understanding the overall long-term strategy helps with the negotiations, as you know, Tara. But my view on specifically when it comes to the exit clauses is that at the moment, there has been very little flexibility in these contracts, and probably you as legal would be able to comment more on this, unless and we've seen that parties have decided to leave legal and what it states in the contract and exit because it was a sour relationship, even if there were no rights to exit from the agreement, at times by paying, but at times also amicably. These are, again, the exception. I think legally, the current contracts do not necessarily leave much room for an owner to exit, even though there is some language in these contracts that allows him. And I think here we will be touching perhaps one of the important things we didn't get the chance yet to speak about is exiting in the case of what is happening, the force majeure. There has been instances in which there is a fire and whether they could exit the agreement. So it's quite broad, but my view is that if from the very beginning it's clear that the owner wants to exit, typically some operators are willing to do that, but at a very high cost reflected in their fees.
Yeah, it's very difficult, you know. I think we all agree that the agreements are designed, you know, to stay in place for the duration of the term, and it's very difficult to exit. And because of that, unless the parties do have a very good relationship with each other, they may have other business in other properties. You know, there's always a discussion on compensation. Sometimes that's a reasonable discussion, sometimes it's not. But ultimately, if there's no mutual agreement to part ways, then the only option is you know, through the dispute mechanism process, which benefits nobody, because then it just, you know, ends up in a bit of a mudslinging process, and you know, the hotel suffers in the meantime. I think it's just interesting to bounce this around going forwards, because I can see owners wanting more flexibility to withdraw. And our experience to date has been, when this has been raised with an operator, you know, it's always a hard no. It's always a hard no. James, is this something that you think, well, I think you're going to be asked it more often, that's for sure. But, you know, do you think there might be a softening from an operator's perspective to allow some flexibility in, obviously, you know, with some compensation? What's your view?
It's really hard, Tara, because as we all know here, my company and all the other operators are valued on effectively a formula of number of contracts and how much those contracts are bringing in. So you introduce a break clause and it really has a material effect, both in terms of cost, unless you can somehow recoup that cost through a termination fee, and also potentially reputational impact. You know, it takes a while for a hotel to come out the ground to stabilize after 3 or 4 years of operation. And then if we talk about having a 10-year break opportunity, where it's like we've only had really 5 years of the opportunity to the asset. So we enter these contracts, as everyone knows, as it's a very long-term relationship deal. And the terms have come down dramatically over the years. You know, you don't really see the 30, 40-year contracts that in some places you used to see before, even 25 years. It's definitely coming down.
Yeah.
10 years is absolutely on the low side. We have, and I know other operators have as well, looked at introducing some sort of break opportunity for compensation payment after a period of time. It would have to be quite an extended period of time. And in certain specific scenarios, for example, on transfer, where more opportunities for sale of the asset, there can be the opportunity for termination. But again, it's something that is super reluctantly agreed to, and it would only be in those specific scenarios that I think we would look at doing it. Certainly, even for more luxury brands as well, it becomes an even bigger proposition or consideration for the owner, as opposed to having it was one of our low scale or mid scale brands where you have many other representations around in the city as well.
It's a difficult one. I mean, I guess the situation is slightly different if you're stepping into a hotel that's operational and that has been, you know, branded previously. But you know, many of the projects in this part of the world are coming out of the ground, as you said. I mean, Giuliano, you know, as an asset manager, it always boils down to this question of valuation versus compensation versus flexibility, and there is a cost to that. What would be your preference? Would you like to see shorter term, maybe taking a hit on, you know, higher fees to have that flexibility of it ending sooner with the ability to renew if everything's going well? Or would you like to see, you know, break opportunities at a cost?
I mean, as an owner and as a sort of a fund manager, which is how we're moving Aldar towards, definitely I love termination upon sales type of clauses, because that not only widens up the type of investors that we could be appealing for the property, but also increase the potential value attached to that property. So for me, that is an essential clause, which is very, very difficult to get in the negotiation with any operators in the Middle East. But for example, I don't mind having a termination for convenience, even if at a relatively high cost, maybe after year 10, and then having a term of 20 or 25 years. That makes the operator happy from one side, but also give me the possibility to spin off from after year 10 if I receive some good offers, or if I think that I'm going to get more value on that property without that rent. We saw here in Abu Dhabi a couple of situations like that with the Etihad Towers. So it would be great to see what was the sort of a negotiation that happened in there. Ultimately, it's also true that this is a very clear point in time in which if you want to exit a certain contract and you have to pay 2 or 3 years equivalent of the last 3 years of fees, 2020 has very low fees, and 2021 will have also very low fees. So by the end of 2021, getting rid of your brand or your operator is going to be much cheaper than getting rid of it last year. So maybe that also going to be a sort of a negotiation point with the operators to ask them for more flexibility in certain points of the management contract, because they know that it's going to be easier for an owners to change their mind and send them home.
Yeah. Okay, interesting. Yeah, I'm not sure there's an easy solution to that one. We've got 5 minutes left. There aren't a huge amount of us, so perhaps we can open up the floor, unmute everybody, and invite you to let us have any comments or, you know, questions if you want to raise anything that we've not addressed. I mean, there's a lot to think about and you know really drill down into, and can't really look at one thing in isolation of another with these hotel management agreements, for sure. But Kelly, do you want to unmute everybody? Sorry, just bear with us. Oh, I think everybody needs to unmute themselves, actually. If they'd like to speak and contribute, perhaps you can unmute yourself. and we'll open up the floor. I think, Chris, you've managed to unmute yourself. I don't know if you've got a comment.
No, I think the question that I had was, relating to consolidation. We talked about flexibility of contracts, particularly from the second and third tier operators. With the consolidation going on, that flexibility is going to be reduced because some of the big brands are going to maintain some of the inflexibility with some of their clauses. So I think you'll probably end up finding, the overall contracts might become less flexible as you move on.
Yeah. Yeah, you might be right, because it's, also it's the smaller operators that typically are a little bit more flexible. I would think that without the scale, they're going to be really struggling at the moment too.
I think
Yeah.
another thing to raise is, we've been talking about, commercial terms. That's been a focal point of this panel so far. But there's a lot of non-commercial clauses and contracts that need to be looked at from an owner's perspective. For example, having the ability to review and change employment contracts, overlooking lease agreements, even having some oversight on the commercial agreements that the sales and marketing teams get involved with. Because if you have a sales and marketing
Yeah.
team that go into a long-term contract with a major tour operator, and they end up having a significant part of your room nights being booked through that particular operator. If they have a case like Thomas Cook, your hotel is going to have a struggle in trying to diversify and get demand in to replace that. So I think owners should have some form of buy-in when it comes to some of those agreements as well, and those contracts.
Yeah, typically that's a very hands-off area, isn't it? Russell, I see that you've unmuted yourself. Is there anything that you would like to contribute?
Well, it did occur to me that there are one or two areas that I don't recall having heard mentioned. So if I'm wrong, then do correct me. But one of the areas I'm concerned about is the imposition of brand standards. And I think that many hotels are discovering, for example, if they've closed and are now slowly but steadily reopening, that they are managing with fewer staff than the brand standards would dictate. And the brands and operators and so forth need to be flexible in order to allow that to continue beyond the immediate future. And I'd be interested to know what the brands are doing in order to be more owner friendly in that respect.
Thank you, Russell.
Yeah, and on that, Russell, I mean, I can't speak for what the other operators are doing, but I think we probably have been pretty aligned in making aggressive cost-saving measures in terms of employees where it's been prudent and possible to do so. And ultimately, if we, as Accor, let's say, are the operator of one of our hotels, we're operating in accordance to the brand standards we set. Now, of course, we say that the owner has to meet those brand standards in terms of the build and the design and everything else, but ultimately we're very hands-on and responsible for operating them in accordance with brand standards. So I think what you'll see is a degree of flexibility coming through there, with everyone knowing that you're going to have to reduce cost structures in the hotel if we're entering a depressed period of the next 2 or 3, 4, 5 years before things get back to what they were, if they ever get back to what they were. So I think you'll find the operators being much more collaborative about that.
I think they're going to have to. And as you say, it isn't necessarily going to be 2, 3 or 4 years. It's going to be forever. And asset managers and owners and so forth are rewriting the basis on which they can make money. And sadly, that is going to come with, for example, fewer staff. And I do feel that not just Accor, but all the brands need to be wise to this. And it will get more difficult as you move further up the luxury chain. Those standards are going to be very hard to achieve.
I think it's very valid, and I mean, just in terms of personal experience, you know, we've been negotiating and closed a couple of hotel management agreements over the last 6 months in different parts of the region, and you know, I haven't seen much flexibility. You know, I haven't seen much movement. I haven't seen a great deal of change in approach, you know, to the points raised in the agreements, and to the, you know, the position of operators pre-COVID and post-COVID. So it would be nice to see everybody having better collaboration, because I think from the owner's point of view, you know, that's actually, it seems like a big ask, but actually, you know, it's just to have a little bit more input. Control's the wrong word, but, you know, input into some of these decisions that are being made during the day-to-day operation. And in terms of the concepts that provide for that in the upfront negotiations, you know, they're not being entertained. So I think it's a watch this space as time goes on as to whether that really materializes and the parties can come closer together, you know, in respect of their competing interests sometimes and their mutual interests at others. But we've run out of time now, so we'll have to wrap it up. I'd like to thank everybody on the panel very much for your input, and for everybody that's joined us. Certainly food for thought, you know, over the next year or two, and we'll see how it pans out. Maybe we can meet up this time next year and see if we've actually made any progress. Thank you, everybody.
Thank you.
Thank you.
Take care. Thank you.
Thank you very much.
Thank you.
Bye.